You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, it's Friday. I always like Fridays, and it's always good to be with you.
We know the global market is interconnected. What happens in Hong Kong can affect everybody. The British election appears to be affecting stock markets.
Yeah, quite a big positive here. There was a bit of a setback earlier in the week when the head of the Fed, Janet Yellen, was talking with Lavarge or whatever her name is at IMF and saying something about U.S. stock market prices being at high valuations. And no doubt it was a calculated statement. And, of course, in previous bull markets, you've always had the comfort of the rising trend and the comfort that the Federal Reserve was there to make everything well and that they would prevent things from going wrong. But more recently on this bull market, it is direct action by the senior central bank in buying bonds for a long time and no doubt on the bid from the stock market from time to time. And so that, rather than an implied comfort, it's a direct comfort. So then to have the head of the Fed say that stock prices are overvalued. But it doesn't matter. One couple of charts I've seen here recently is a chart of U.S. macro announcements, all the big economic stuff they watch. Well, somebody's making an index, a chart of it. And since November, it's been heading down quite impressively. And since October, you've had the stock market going up. So the way that we've been looking at it is that the decline in these macro numbers may be suggesting a cyclical contraction in business and whatever, but the stock market's moving on a seasonal, which can often be positive from October to around May, and it's been positive. So then there were some overnight. Oh yeah, the other chart on that was cash flow flows into the U.S. equities, which had been diminishing, going up. But then there was one I saw here with the guys at Zero Hedge were trying to figure out, well, who the hell really is doing such concentrated buying of equities? And it turns out that the Swiss central bank has to report, and a report that's been aggressively buying equities at these elevations. Some sort of madness. But then we should look back to 1998 when the big rage was long-term capital management, which was a hedge fund using all of the latest in intellectual ideas about pricing of warrants and options and all that sort of stuff. So they were long the main trend, which was narrowing credit spreads on the European Union coming back, getting together, and that all different, like Italy and England, would all trade on the same yield basis. So there was much money to be made in that, very leveraged. But the guys seem to overlook that spreads can narrow going into May, June, and that's a seasonal one, and if you got great excitement, you can watch for a great turn. But the main thing is that all the intellectuals, academics, and economists were so in love with the reputation of the guys at LTCM that the senior central banks were lending money directly to LTCM for their leverage. And the Bank of Italy got totally carried away with the intellectualism of it and actually took an equity, loaned the money plus took an equity position, so that then in the summer of 1998 you had the typical reversal into widening credit spreads, and that, beginning that July, it was starting to push LTCM's assets down fast. And then they had to liquidate. And then you had the problem of the senior central banks trying to get their money back out of the fund. And who knows what Italy did with their equity position. But here you have now an exceptionally hot, a strong bull market showing signs of being extreme, and the Swiss bank announced that they're buying equities. I think it's sort of a Me Too kind of thing where you see sometimes various government agencies, and it's a great bull market, and they don't have money to buy on their own, so they're using taxpayers, or in this case central bank's money, to get in on the party. It's ridiculous. So we'll see what happens there. And in the meantime, you've had our what we called the rotation, where in December wrote that commodities, some of the basic commodity prices were somewhat depressed, and including gold and silver. And of course, in January, many of them really got depressed on the crash in crude, which was likely to end in December or January. So we advised that maybe we'd get another rotation whereby depressed commodities would rally out to around May, where we are now. So on this kind of research, you look out and say, yeah, is the market up when it should be? Yeah. Are there signs of speculation? Yeah. Take a look at crude, from 43 to 60, and you got momentum, upside of momentum on these things. So yeah, and you're getting a good move out of base metals. But looking at the energy side, you've had a good move in oil patch stocks. On the base metal side, you're getting a very good move out of the senior mining companies. And a matter of fact, these are more or less up to the points where you say, hey, this is very positive. So the question is it up when it should be? Yep. Are there signs of speculation? Yeah. So then you look for the real excess that sets it up for a reversal, which could be happening now. The grains did do a mild recovery, but not much, because all of a sudden they were getting some precipitation in some grain-growing regions in the U.S. where they had been particularly dry. So grains have not done too much. We also had a severe decline during this period with lumber. It was going its own way, and it came down to an extreme oversold, I guess about 5-6 weeks ago. And all it's been doing really is stabilizing. It's not much of a bounce there. So what we're concerned about in commodity prices, plus the help from the U.S. dollar on crude crash into January become exceptionally overbought. So we advised on that and noted that you would have more or less an intermediate correction. And, well, we've had it. A good decline in the U.S. dollar, and it looks like it's poised to set up to stabilize for a bit and then probably rally. So when you look at the credit spread, happy into May, and June they can reverse, and you've got happy in some of the commodities. So after mid-year, let's give ourselves some room there. Credit spreads could be turning towards adversity. I think the stock market would be backing off of this speculative high here now and churning around through the summer. But if you have a steady move towards deterioration in credit markets, and it's possible, you're looking at perhaps the typical October being kind of a heavy-duty decline in there. But let's look at this rally now, peaking somewhere in the next few weeks, then a correction and churning around during summer months.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. What's going on with the gold market, Bob?
Now, a week ago, we wrote that on the gold stocks, which we prefer to trade, they had a decent rally out until late February, correction back, and then this next rally to last week didn't make it as high as on the first rally. And so looking around, we thought, well, let's just, we've got a gauge, let's take some money off the table because we're uncertain about the strength of the markets in the last half of the year. Seemed prudent to take some money off the table. So anyways, there has been a correction in that side. And then also, we're looking for this correction down in the U.S. dollar to find an end in here somewhere. So it wasn't as big a gain as last year where the rally from, December out to May was outstanding. And we had a very good overbought in the play in precious metals a week in May a year ago, but this one wasn't as robust. But nonetheless, considering all these other hazards and difficulties out there, take some money off the table on strength in here and have it as a reserve for maybe good buying opportunities out in the fall. And the other one is on the bond market here. This one, the rise in yields in Germany has been amazing. We're talking very small numbers, because the decline in yield into, I think it was April 17th, was down to, let's just sort of say 0.06%. And on the U.S. Treasury bond late in January, February, we had a very strong overbought on there and suggested that this was ending action in the whole bull market for bonds as represented by U.S. Treasuries. And then we also felt that this would eventually affect the mania for bonds in Europe. And of course the main focus was the German bond, which I say got down to that absurd yield. Well, in 2 weeks jumped to 0.6%, but the decline from 0.6 was back at Christmas time. So it took like 2 weeks to undo 4 months of trend. And that is outstanding. So there was any of the longs on that one have been offside, and actually it became a natural for aggressive traders to short the euro or the German 10-year note because down to zero interest rates, the cost of carry was effectively zero. So it was kind of a very, very good place to be. And it reminds of in 1992 when big traders such as George Soros had been shorting currencies as they broke and making money, and then took on the Bank of England in being short sterling. And then when it broke, it was reported that he made about $2 billion on that trade. And I remember at the time, you could see it was went from currency to currency, then sterling, and then the one thing left that looked like it was going to go was gold, and you expect the whole trade to go there and have gold going up. But the authorities then made major moves to put a lid on gold. It wouldn't, they weren't going to let it go up. As I heard stories at the time where they were flying 747 loads of bullion in 747s to Zurich to provide enough for delivery to quell that rally, which did happen. But here we are, many years later, on a situation where, and then it was the Bank of England defending sterling against Mother Nature. And here you've had the European Central Bank defending an absurd idea about lowering interest rates by buying bonds. And that true is also against Mother Nature. And I'd be delighted to see some big shorts in there making lots of money out of this, because they're all set at some point to hit them again. And it's time that these authoritarian central bankers with an amazing audacity, they should be humbled greatly. And I think the Mother Nature and Mr. Margin can do that, probably being more visible after September. And I think it'll be fun to watch.
Bob, thank you very much for chatting with us.
Always good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HoweStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. You can forward comments for the show to info@HoweStreet.com. I'm Jim Goddard.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.